Okay, let's dive in. Think about this feeling. It's 2008, and the whole global economy feels like it's, well, genuinely teetering on the edge.
Yeah, the edge of collapse.
Exactly. Hank Paulson, who was Treasury Secretary then, he called it an economic 911, said the world economy could just crumble within 24 hours.
And Ben Bernanke, the Fed chair, told Congress something I think even more chilling.
What was that?
He said, "We may not have an economy on Monday." Imagine hearing that.
Wow, just wow. That level of fear, that feeling that everything could just stop, that's really where our deep dive kicks off today.
Those quotes, they really capture, don't they? The almost unimaginable pressure those policymakers were facing right then.
And the book guiding us through this this whole period and everything that came after is Adam Tooze Crashed: How a Decade of Financial Crises Changed the World.
A really comprehensive look.
It is. And our mission here is basically to unpack that source material, pull out the key insights, and really understand how that decade of crisis reshaped, well, everything: the global landscape, the responses, the power shifts.
And it's not just about 2008, is it? The book really focuses on the decade that followed. It kind of sets the scene around 2012, 4 years after the initial shockwave.
Right. And if you looked around in 2012, you might have thought, okay, American corporate liberalism, especially under Obama, it sort of weathered the storm, maybe even came out on top.
Yeah, the immediate acute threat felt like it had passed.
Mhm.
America hadn't been, knocked off its perch.
Emerging markets were actually doing pretty well, partly thanks to the Fed.
Yeah, exactly. And Obama was pushing that indispensable America idea again, pursuing those big trade deals, TTIP and TPP, which, let's be honest, had a big geopolitical angle too.
So that 2012 perspective, that sense of maybe things are getting back to normal, that's our starting point for seeing how much actually changed in the years that followed.
Precisely. It's the deviation from that point that the book explores.
Okay, so let's dig into the roots of the U.S. crisis first. Even before 2008 really blew up, there was this undercurrent of concern about debt. The source mentions even Obama, early on, kind of echoing this economic nationalism, saying we need to keep debt low and out of the hands of foreign nations.
That debt anxiety was definitely there. And it was a big shift from the Clinton years. Under Robert Rubin, remember, they actually had budget surpluses.
Then under George W. Bush, things went, as the source puts it, in the wrong direction. Tax cuts added massively to the deficit, what was it, $1.35 trillion over 10 years?
A huge swing. And while some worried about domestic investors, the so-called bond vigilantes,
Right.
the crowd around Rubin were apparently most worried about foreign investors bankrolling those deficits.
Because U.S. treasuries were seen as the ultimate safe haven, but if foreigners suddenly got spooked.
That was the nightmare scenario. An Orszag and Rubin paper pointed this out. If foreign investors started doubting the U.S.'s finances, the fallout could be way worse than standard models predicted.
And the CBO, the Congressional Budget Office, even modeled this back in 2003. Foreigners stopped buying U.S. debt. The dollar tanks, interest rates, inflation shoot up, markets crash, spending dries up.
And it spills over globally, a complete meltdown scenario.
It really makes you think, just how central was foreign money to keeping the U.S. system stable before it all went wrong? It feels like more than just a factor, maybe a pillar.
A critical dependency, absolutely.
Yeah.
Okay, so shifting from that big picture of debt to the actual spark, the subprime mortgage mess.
Right.
The book makes a really important distinction here. Just having losses on these complex mortgage products, these asset-backed securities, if they'd just been spread out among lots of investors globally, well, that wouldn't necessarily cause a full-blown banking crisis.
Like the dot-com bust, that was bad, a recession, but not a systemic financial collapse.
Exactly. The killer difference this time was that, contrary to the whole idea that securitization spreads risk, hundreds of billions of dollars worth of these mortgage-backed securities, these MBS, weren't spread out. They were stockpiled, piled up right on the balance sheets of the very banks creating and selling them.
So the originators and the securitizers were holding on to the hot potato themselves. Why? Why would they hold their own product like that?
Well, part of it was sort of technical. When you slice these mortgages up into different risk levels or tranches, the least attractive, riskiest ones were harder to sell. So the issuer often got stuck with them.
Okay, so they had to keep some dregs.
But it was more than that. They believed the hype. Holding these MBS was incredibly profitable at the time, especially with borrowing costs so low. They wanted in on the profits.
So they drank their own Kool-Aid, basically. They thought the risk models were right.
Pretty much. And it's interesting, the source notes not all banks took the same gamble.
Yeah, you had Citigroup, Bank of America, WAMU, Lehman, Bear Stearns going really big on holding this stuff.
Huge risks. But then you had J.P. Morgan pulling back on mortgages and actually buying insurance,
Yeah.
credit default swaps against collapse.
And Goldman Sachs famously bet against the housing market, right? Made a fortune.
They did. So it shows it wasn't just, everyone blindly walking off a cliff together. There were different strategies, different risk appetites.
Okay, so the U.S. is the epicenter, but the shockwaves hit Europe almost instantly. The book really stresses how interconnected things were. European banks' claims on the U.S. were the biggest single link in the whole global system.
Absolutely massive. And European financial centers, especially London, were basically acting like a giant global hedge fund.
How so?
They were borrowing huge amounts short-term, often in dollars, and then lending that money out long-term, chasing higher returns, often funneling money from Asia or the Middle East into riskier U.S. assets.
And London has history here, right? With offshore dollars, the Eurodollar market.
Yes, that goes way back. It actually predated and even helped undermine the old Bretton Woods system. Then you had deregulation in London in the 80s, the Big Bang.
Which opened the floodgates to global capital and saw UK banks get swallowed up by American and European firms.
Precisely. And the irony, as one U.S. regulator apparently put it later, was that the U.S. effectively outsourced a lot of its financial risk-taking to London.
Only for it to boomerang right back when the crisis hit London's banks.
Come right back here, crash into our shores. That was the quote. And Europe, meanwhile, was having its own huge credit boom alongside this.
Fueled by the same global factors.
Very much so. European banks were right at the cutting edge of that early 2000s credit expansion. And the Eurozone itself played a role.
How?
Well, the single currency eliminated exchange rate risk between member countries. So cross-border lending within the Eurozone just exploded.
And they adopted U.S.-style securitization, too.
Oh, yeah. It caught on fast. UK and Spanish banks were particularly big players, alongside older models like Germany's very traditional, supposedly safe fan brief, those covered bonds.
But places like Spain had issues with their regional savings banks, the cajas, didn't they?
Yeah.
Tied up in local real estate bubbles.
Big time. And attempts to rein them in met a lot of resistance. But structurally, even with all the talk of Eurozone integration, Italy tightening its belt, figures like Monti, Draghi, Prodi involved.
There wasn't much urgency about building the safety nets.
Exactly. The book points out there was little urgency about creating the kind of fiscal tools, shared budgets, ways to redistribute funds that you'd need to handle a major recession hitting the whole bloc.
And that moment in 2003, when the EU didn't enforce deficit rules against France and Germany, that must have sent a signal.
It did. For some, it showed a lack of commitment to fiscal discipline. For others, it raised questions about Germany's own economic strength. Either way, it left the Eurozone pretty exposed when the storm finally hit.
Which brings us back to the U.S. and the moment it really hit the fan, Lehman Brothers.
The decision to let Lehman fail. September 2008.
The market reaction was just sheer terror, wasn't it? The Dow had its biggest ever point drop at the time, 778 points, wiped out $1.2 trillion in value in hours.
Worse than 9/11 for the markets.
Yeah.
Immediately. And that single event just instantly synchronized the crisis. The U.S. and Europe were suddenly locked together in this downward spiral.
And the human cost globally, just staggering.
That second quarter of 2009, the source calls it a massive synchronized recession. 52 out of 60 reporting countries saw their GDP shrink. Tens of millions lost their jobs.
We saw the pictures of bankers with boxes, but the book emphasizes it hit, who was it? Young, unskilled blue-collar workers the hardest.
Yeah. In the U.S., job losses hit over 800,000 a month at the peak, and unemployment surged particularly dramatically among African Americans. Just devastating.
Faced with that potential abyss, the scale of the response had to be equally huge. Officials like Bernanke and Paulson later described it as, well, traumatic.
You can only imagine the feeling must have been that if they didn't act, right now the whole system could just seize up entirely.
So the Federal Reserve basically became the world's fire department, stepping in as lender of last resort, pumping in unbelievable amounts of liquidity.
Through things like the term auction facility, the TAF, essentially short-term loans to banks. By late 2011, the total lent through that was equivalent to something like $6.18 trillion in 28-day loans.
Wow. And not just to U.S. banks, right?
No, lots of smaller U.S. banks used it, but the really big money went to the giants, including many European banks. And then there was the ST Momo program.
Short-term open market operation.
Yeah, another $855 billion through that by the end of 2008. And again, foreign banks were major takers, 5 European banks got most of it. Credit Suisse alone took 30%.
But maybe the most crucial, almost ingenious tool were the swap lines the Fed set up.
Absolutely critical. These were basically agreements where the Fed would swap dollars for another central bank's currency, like euros or Swiss francs.
So it was like giving foreign central banks direct access to dollars.
Exactly. A dollar credit line, essentially. The scale was immense. Total lending and repayment through these swaps hit $10 trillion by September 2011. If you standardize it, that's like $4.45 trillion in 28-day loans. The European Central Bank was the biggest user by a long shot.
And the real insight there isn't just the sheer amount of money, it's what it signified structurally, isn't it?
Precisely. This wasn't in any textbook. It was improvised emergency plumbing for the global dollar system. It powerfully reaffirmed the dollar's centrality, and it established the Fed, maybe unexpectedly, as the indispensable central node of that whole network.
The message was, if private dollar funding dries up, the Fed is there. Unlimited dollars.
The global lender of last resort role effectively performed by the U.S. Federal Reserve.
So fast forward a bit to around 2012. The immediate fire in the U.S. seems contained, maybe smoldering, but Europe's problems are actually getting worse. It's become a sovereign debt crisis.
Yeah, Europe became the world's problem, as Italy's Mario Monti put it. He even compared it to the Titanic.
And there was pressure from outside, especially the U.S. Geithner was pushing them to act more decisively.
Very vocal. G20 meetings in 2012, Camp David, Los Cabos. Europe's crisis was still front and center. Remember Barroso, the EU Commission president, snapping back at that Canadian journalist?
Vaguely. What did he say?
Something like, look, this crisis started in North America. We're not here to take lessons. Shows the tension.
Meanwhile, within Europe, the push for austerity, led by Germany and France, resulted in that fiscal compact in late 2011. But the support for endless belt-tightening was starting to fray.
Even the IMF started sounding warnings by early 2012. They talked about the paradox of thrift.
Yes.
The idea that if everyone, people, companies, governments, all try to save money and cut spending at the same time, it just kills overall demand and pushes you deeper into recession. The IMF saw this as a major global risk, and Greece was Exhibit A.
Ah, Greece. The images from Syntagma Square. Huge protests, 200,000, 300,000 people.
The austerity imposed there, the demands from the Troika, the Commission, ECB, and IMF, it just provoked this furious reaction.
And the source highlights how this economic misery directly fed political extremism.
It's really stark. On the left, you saw rhetoric linking German austerity demands to, well, Nazi occupation, tapping into deep historical wounds.
And on the right?
The rise of Golden Dawn, an openly fascist party. Parades, violence against immigrants and leftists, those Greek-only soup kitchens. The source calls it a textbook rerun of the 1930s, a chilling reminder of how economic despair can fuel the darkest political forces.
Stepping back again, let's look at how other major players responded. China's reaction was massive stimulus, right?
Huge. 4 trillion yuan announced in November 2008. And interestingly, mostly decentralized. Local governments drove a lot of it using Communist Party networks.
Unleashing just a tsunami of infrastructure spending.
Unbelievable amounts. Hubei province alone planned more construction by 2010 than the entire U.S. stimulus package. It worked to stabilize China's growth, but it also reinforced worries about their unbalanced economy, too reliant on investment.
And other Asian countries, they seemed more resilient this time.
Yeah, places like Thailand, Malaysia, South Korea, they'd learned from the 97 crisis, less reliant on the IMF. South Korea even got a swap line directly from the Fed, partly to avoid the politics of going back to the IMF. They bounced back faster.
China also made that quite bold pitch in 2009 to challenge the dollar, suggesting a new global currency based on the IMF's SDRs.
They did, and got backing from France and Russia. Obama shut it down pretty quick. Didn't think the world needed a global currency.
But Geithner initially seemed a bit open to it.
He did. Said he was quite open to SDR evolution. Caused a brief panic in currency markets, and he got slammed by Republicans and Fox News for supposedly trying to ditch the dollar. He had to walk that back fast.
Even within allies, there were tensions. In the UK, the Bank of England governor publicly contradicted the Prime Minister.
Highly unusual. Mervyn King, March 2009, basically said, hold on, maybe we shouldn't do more big fiscal stimulus, pointing to the UK's large deficit. This was directly contradicting PM Gordon Brown.
What was the effect?
Rattled markets. The very next day, a government bond auction had terrible demand, the worst on record. A bit of schadenfreude for the opposition, the source notes.
And back in the U.S., after that initial burst of action, Obama faced real political headwinds, didn't he? Getting more done on the economy became tough.
It's very tough. They passed another bill in late 2010, but it was largely extending Bush tax cuts, arguably. And that was pretty much it for major economic legislation.
Why?
The 2010 midterms brought in a Republican House majority dead set against tax increases and demanding immediate spending cuts. The whole starve the beast strategy, it created gridlock. Things like the Simpson-Bowles Deficit Commission recommendations just went nowhere.
It feels like the crisis, and especially the bailouts, became this real dividing line in U.S. politics.
Yeah.
The source brings up Steve Bannon.
Yeah, the alt-right figure. His quote is stark. "I'm a Leninist. I want to bring everything crashing down."
What did he mean by that in this context?
For people like him, the crisis and the response exposed what they saw as a corrupt, true power structure, propping up a system, including the welfare state, that they believed was unsustainable. It fueled this desire to tear it down and fight the liberal elite.
And the book frames the Trump presidency later on as almost an audit of everything the Democrats tried to build or regulate after 2008.
It's exactly. Trump's goal of overturning the Obama legacy tested how durable those post-crisis reforms really were, especially after years of Republican pushback in Congress fighting stimulus, the ACA, using the debt ceiling.
So how did that audit play out under Trump policy-wise?
Well, big tax cuts, famously denounced by a UN rapporteur as making the U.S. the world champion of extreme inequality. Though historically, tax cuts like that haven't actually shrunk government, especially when paired with plans for big military spending increases.
And deregulation.
They tried legislatively, like with the Choice Act aiming to gut the Consumer Financial Protection Bureau, but that faced hurdles. A lot happened through agency discretion, which Dodd-Frank allowed for. Nugent's Treasury adopted bank lobby ideas, weakened the Volcker Rule.
Which was meant to stop banks gambling with their own money.
Right. And the book makes a point that the system for winding down failed megabanks, the Orderly Liquidation Authority, ultimately relied on having officials committed to using it for stability. That design could be a weakness if officials weren't so inclined.
It seems like some of the anger tapped into by Trump, and maybe Bernie Sanders too from the left, resonated because they were saying things that felt obvious, that the economy was politicized, that financial globalization wasn't some neutral success story for everyone.
There's definitely that interpretation. Greenspan himself worried late in life about crazies undermining the system. And his critics immediately fired back, saying, well, weren't your post-crisis policies QE, zero interest rates that created a false economy and artificial stock market? Weren't they crazy too?
So it challenged the whole consensus.
It questioned whether financial globalization, as institutionalized by figures like Greenspan, was this inevitable good, or a political project with real consequences and, yes, winners and losers.
Let's shift focus again, the post-Soviet sphere. How did the crisis and its aftershocks hit there?
By 2014, that whole region faced what the source calls a comprehensive crisis, geopolitics and finance colliding. Russia took a hit, but its neighbors often suffered more. Currency devaluations were brutal. Kazakhstan, Azerbaijan, Belarus currencies halved against the dollar, and remittances dried up. Think about Tajikistan. Half the income for working-age men came from money sent home. That's catastrophic.
And the Ukraine crisis was unfolding around then, too.
Yes. Ukraine leaned toward Europe, but financially it was on shaky ground. Debt restructuring gave bondholders, hedge funds mostly, only minimal haircuts while the economy tanked. The West's support was seen by some as falling short, not really saving Ukraine financially or stopping Russia decisively.
Sanctions hurt Russia, but didn't break Putin's grip.
No. He consolidated power at home, found allies or sympathizers in unexpected places, including the U.S., and showed Russia could still stir up trouble.
And across Europe, beyond the immediate Eurozone crisis, we saw that broader nationalist wave building, eventually leading to Brexit.
Definitely. Alongside Greece, you had Le Pen in France, UKIP in the UK, the Danish People's Party gaining traction. Then the UK Conservatives won in 2015 and were locked into holding the EU referendum.
Cameron tried to negotiate some concessions from the EU first, right?
He did. An emergency break on migrant benefits, acknowledging the UK wasn't aiming for ever closer union, things like that.
But the EU held firm on core principles.
Especially freedom of movement. That was non-negotiable. The source suggests Britain's position was already weakened, its brand was toxic, and the concessions offered were pretty minimal, little of substance. The stage was set for the Leave vote.
So it seems Trump's later rhetoric, even if it was, as the source says, uncouth belligerence, sometimes pointed to real underlying issues: German surpluses, clashes between ECB and Fed policies.
That's a key argument in the book. It pushes back against the idea that Trump was just this sudden break from a happy liberal consensus. That consensus was already fraying.
How so?
Well, the last big global trade deal, Doha, collapsed back in 2008. World trade growth had already stalled out around 2010. That wasn't just Trump. It was the business cycle. The Fed's taper tantrum messing with markets, commodity prices falling, and a whole wave of protectionist measures countries put in place before Trump.
So he was amplifying existing trends, perhaps.
In some ways, yes. His style was unique, but the frictions he pointed to, trade imbalances, monetary policy divergence, were already there.
And all this time, China's global stature is just continuing to grow. By 2017, Xi Jinping is at Davos, presenting China as an anchor of globalization.
Quite a moment. Very different from 2009 when they felt they needed to propose a whole new currency system. By 2017, Xi could just show up and confidently endorse the globalization narrative. It signaled China's arrival as, undeniably, a superpower.
But the book reveals something surprising, a new vulnerability for China that emerged around 2015. What was that?
Yeah, this is fascinating. Despite having huge trade surpluses and reserves, China actually faced fears of a currency crisis around that. It felt, as the source says, eerily reminiscent of 2008 for places like South Korea or Russia.
How could that happen with a trade surplus?
Because financial globalization was now working differently for China. Even with a trade surplus, Chinese companies, banks, even individuals had started borrowing heavily in foreign currency, mostly dollars.
So they built up dollar debts.
Exactly. And that made them vulnerable. Suddenly, shifts in U.S. interest rates or the dollar's value could hurt them badly, just like any other financially integrated economy. China hadn't really been plugged into that specific dynamic back in 2008. Its integration was more trade-focused then. But since the crisis, it had become much more financially intertwined globally.
And they weren't afraid to flex their muscles on global policy, even telling the U.S. Fed what to do.
Pretty much. October 2015, Finance Minister Liu Jiwei basically told the IMF the U.S. couldn't raise interest rates yet because of its global responsibilities tied to the dollar. That kind of directness certainly complicated things for Western analysts trying to guess the Fed's next move. Was Beijing now part of the calculation?
So quite a journey we've traced, from that 2008 precipice, through a moment around 2012 where maybe U.S. dominance seemed okay, to a world years later still profoundly marked by the fallout.
Yeah, a landscape defined by political polarization, especially in the West. These big shifts in global power with China's rise, new financial vulnerabilities popping up, and this persistent undercurrent, sometimes overcurrent, of nationalism.
The book suggests we should think about 2008 almost like 1914. Not literally, of course, but as one of those hinge moments in history.
A moment of decision, contingency, high drama that really shapes everything that comes after, sparking endless debate and rethinking. And that feels especially relevant right now with the conflicts and tensions we see around the world today.
Absolutely. So considering all that interconnectedness the crisis laid bare and the shifts in power and politics we've talked about, here's a final thought for you, the listener. Where do you see the biggest vulnerabilities, the greatest potential for instability in our global system right now? Something to mull over, based on everything we've dug into today.